Welcome to The Explainer. Today we're going to dive into a trading concept, a really powerful one from Dale's Guide on Volume Profile. And honestly, it's going to challenge pretty much everything you thought you knew about how the markets really work. All right, let's just jump right in with the fact that, well, it's pretty staggering. In pretty much any market you can think of, Forex, crypto, you name it, it's not an even playing field. A very, very small group of players, we're talking the big institutions, they control almost all the volume and capital. I mean, look at this chart. They've got 96% of the market. That leaves people like us, the retail traders, with just a tiny little 4% slice of the pie. So that just begs a massive question, right? For every single one of us trying to make it in the markets, if it's their game, if they're the ones with all the money and all the power, how on earth are we supposed to win? How can we possibly find a consistent edge? So, the guy who wrote the guide we're digging into today, his story is probably going to sound really familiar. He started out just like most of us, right? Totally lost, trying every indicator under the sun, basically using all the wrong tools to try and survive in what is, let's be honest, an institutional playground. He was on that classic hunt for the Holy Grail indicator. You know the one. But in his own words, he just sucked. And the reason why it is so important, he had this realization that all those standard indicators, your moving averages, your RSI, all of them, they're fundamentally broken. They only look at two things, past price and time. That means they're always looking in the rearview mirror, and they totally miss the one thing that's actually driving the market right now. And this right here, this is a huge one. It's a myth we're all taught. Oh, the price moves because there are more buyers than sellers. It sounds logical, but it's just not true. The reality, price moves because of aggression. It moves when one side gets impatient and starts smashing the market order button to get in or out immediately. That's the force that actually pushes price. So you see, the big breakthrough, the real mental shift here, isn't about trying to be a fortune teller. It's not about predicting where the market might go. It's about becoming a detective. It's about tracking what the giants, the institutions who actually have the power to move the market, are doing right now. So the goal changes completely. We're not looking for some magic indicator that's going to let us go toe-to-toe with these giants. No way. The goal is to follow them. And how do we do that? We learn to read their footprints, their tracks, right there on a clean price chart. This is pure price action. Think about it this way. You don't fight a whale. You surf in its wake. Okay, so what are we looking for? Well, the source breaks it down into three major clues, three giant institutional footprints. First up, you see price just going sideways for a while? That's them, quietly building a massive position. Second, a sudden aggressive trend kicks off. That's them showing their hand, revealing which way they're about to push things. And third, a really strong rejection. Price hits a level and just gets slapped back down. That's them defending a key area with everything they've got. Now, price action is great. It shows us that the institutions acted, but it doesn't tell us the full story. It doesn't show us how much skin they have in the game. To see the precise level of their commitment, we need something a little more powerful. An X-ray, if you will. And this is it. This is where volume profile enters the picture. And trust me, it's a total game changer. Forget guessing. This is like getting an X-ray of the market. It lets you peer inside and see the hidden structure. See exactly which price levels the big institutions care about the most. Okay, so here's the absolute key difference, and you gotta get this. That normal volume indicator you see at the bottom of your chart, that tells you when a lot of trading happened. At 10 a.m. volume was high. But volume profile, which runs down the side of your chart, tells you where the trading happened. It says at this specific price, a ton of volume was traded. And knowing where instead of when is, well, it's everything. It's infinitely more powerful. Now, within that volume profile, there's one level that's king. It's called the point of control, or POC. It's super simple. It's just the single price level where the most volume, the most business was done. You should think of this level like a magnet for price. It's an insanely powerful support or resistance level because it's literally the spot where the institutions have the most interest. All right, so theory is great, but how do we actually trade with this stuff? Well, it all boils down to three core repeatable setups. And the beautiful thing is, these aren't based on hope or guesswork. They are based entirely on tracking that institutional volume we just talked about. Okay, setup number one. You find one of those sideways ranges, right? The place where institutions were quietly loading up. You draw your volume profile over that range and you find the point of control, that high volume spot. Then you just wait. When price breaks out and then comes back to retest that POC, that's your entry.
Setup number two is for when the market is already trending hard. You look for those little pauses, those little consolidation areas within the trend where volume builds up. That's where the institutions are adding to their positions, pressing their bets. You find the heaviest volume point in that little cluster, and that's where you look to get in, expecting that trend to kick off again.
And finally, setup number three, the rejection. You see a really sharp, aggressive reversal on your chart, maybe a big long wick or a pin bar. Here's the cool part. You apply the volume profile just to that wick. The POC of that rejection wick shows you the exact price where institutions drew a line in the sand and slammed the brakes on the market. That's your entry.
So why does this work so well? The logic behind it is it's simple and it's powerful. Reason one, institutions have to defend these high volume areas. I mean, they've got billions of dollars on the line. They're not just going to let the price run against them. And reason two is just as important. Other traders see this institutional strength, they get scared, and they close out their positions. That selling or buying just adds more fuel to the move we want to see.
So let's wrap this up. What's the big takeaway here? It's really about a fundamental shift in how you see the market. Stop trying to predict the future with lagging indicators. Instead, start reading the market through the lens of institutional volume and, more importantly, institutional intent. You're not guessing anymore. You're just watching what the big money is doing and reacting. And the best part? Because this logic is universal, it's how the big players operate, period. It works on any time frame. It doesn't matter if you're scalping on a 5-minute chart or you're swing trading on the weekly. The principles of tracking institutional money are exactly the same. So this whole explainer really leaves us with one final big question to think about. Most of the trading tools out there, they're analyzing time, but the real money, the smart money we're trying to follow, they operate based on intent. So the question you have to ask yourself is this: when you look at your charts, are you analyzing time or are you analyzing intent?